Welcome to this revision series on accounting standard. I hope that this revision series will help you to quickly build your concepts and cover all the accounting standards in detail. If you like these accounting standards revision, do let me know by liking the video, by sharing this video with your friends and commenting your feedback, and also do not forget to subscribe our channel. So let us start on with this. Right guys, so let us start on with the revision of accounting standards 16 borrowing costs. First we'll cover up the contents of the standard, and then we'll move on to certain very important practical questions from the exam perspective. When we say borrowing cost, in the most simple sense, it would mean the expense which we incur in relation to the loans which we take. So borrowing costs are interest and other costs which are incurred by an enterprise in relation to borrowing of funds. All of us know about interest, and we also know that the interest expense is charged to PL, but this standard will suggest another treatment wherein under certain circumstances we can accumulate the interest expense or the borrowing cost with the cost of certain assets. So let us look at the definition of borrowing cost. Borrowing costs are interest and other costs incurred by an enterprise in relation to borrowing of funds. Borrowing cost may also include interest and commitment charges. Interest, all of us know, which is on time proportion basis, right? It is at a certain rate which is pre-agreed between the borrower and the lender. What are commitment charges? Let's say if I go to a bank or a financial institution and I tell them that I want a loan of rupees 100 crore. Out of this 100 crore, during the year I utilize only 60 crore. So I have blocked their borrowing or lending capacity to the extent of 40 crore because I will pay interest only on the amount which I have utilized of 60 crore. But this 40 crore they have blocked for me. I may withdraw it whenever I want. So if I am not utilizing this 40 crore, the bank will ask for certain penal charges or commitment charges which I need to pay. Then amortization of discount or premium in relation to borrowing. Let's say we are issuing debentures for a period of 5 years, and if these debentures are issued at discount, this discount is an expense to the company which it needs to charge up to the PL over a period of 5 years. Maybe our debentures are to be redeemed at a premium. So this extra which the company is paying, right, is also treated as borrowing cost, and it has to be amortized over the period of the debenture. Amortization of ancillary costs in relation to borrowing. So when we are doing borrowing, right, there are certain expenses which are incurred in relation to arrangement of fund. Maybe we need to submit our project report, we need to make financial statement in the way the lender wants it. So these costs which are incurred in relation to arrangement of funds will also be treated as borrowing costs. Finance charges in relation to a finance lease will also be treated as borrowing cost. And para 4E, which is very important, exchange difference arising on foreign currency borrowings to the extent it is regarded as an adjustment to interest cost. Let us understand this para 4E with the help of an example. See, when I want to borrow certain funds, I will have an option either to borrow it from India at a rate which is offered to me in India, or I may do a foreign currency borrowings as well, and normally it is seen that the foreign currency borrowing, the interest rate is lower as compared to the Indian rate. Let's take an example. Let's say I want to borrow 73 lakh rupees. I have an option to borrow it from India, let's say at an interest rate of 11%, or I can borrow this same 73 lakh rupees from US in a USD loan, and I will have to pay interest at the rate 6%. So if I am taking a foreign currency rate loan, the interest will be paid at 6%. If I am taking the same loan, same amount in India, I have to pay 11%. So there's a difference of 5%, which definitely a business would like to save. But if I am taking a foreign currency loan, I am also exposing myself to foreign currency fluctuation, and I may incur certain losses if there is an adverse movement in the exchange rate of Indian currency vis-a-vis the USD. So therefore this saving which I am doing in interest, right, the difference which is the amount of interest which I would have paid had I taken an Indian currency loan at the rate prevalent in India, and the interest which I actually pay on the foreign currency loan is the saving which I am doing in the interest expense. And for doing this saving, I am taking a risk. I am exposing myself to foreign currency fluctuation. So foreign currency fluctuation, to the extent of this amount of interest I have saved, will be treated as interest expense and will not be regarded as exchange difference under accounting standard 11. Let us look at it with the help of an example. Let's say X Limited takes a USD loan of $10,000. Sorry, make it as $1 lakh. X Limited takes a USD loan of $1 lakh on 14X1 at an interest rate of 6% payable annually. Same loan in INR, which is our local currency, could be taken at 11% per annum. So there's a difference of 5% which the company want to save. The exchange rate on 14X1 is 73 and the exchange rate at the year end, which is 31st March X2, is 78. So when I take this loan on 11X1, I am taking $1 lakh and the exchange rate is 73. So I'll get 73 lakh rupees in my account. At the end of the year, I have to pay interest at the rate 6%. So $1 lakh into 6% and I'll convert it at the year end rate of 78. I need to pay an interest expense of 4,68,000. Now, there is a difference in the exchange rate. I'll calculate foreign currency fluctuation. I had taken a loan and my liability was recorded at 73. Now at the year end, the exchange rate is 78. So there's a loss to the extent of 5 rupees per dollar, which is 78 minus 73. So total exchange difference is $1 lakh into the closing rate and the rate at which I had taken the loan. The 5 lakh rupees is my exchange difference, less considered interest expense as per above para 4E, which is the interest expense had the loan been taken in INR minus actual interest expense on USD loan. We all know that the actual interest expense on USD loan is 468. Had I taken this same amount of 73 lakhs in India, I would have paid interest at the rate 11%. So 73 lakhs into 11% minus 4,68,000 is the amount I tried to save by taking this loan. So I saved 3,35,000, whereas the exchange loss happened to be 5 lakh rupees. So to the extent of this particular savings, this will be treated as an interest expense and balance amount will be treated as my foreign currency fluctuation. So the actual foreign currency fluctuation of 5 lakh will be divided into two portions. One portion will be treated as interest expense, another portion will be treated as foreign currency fluctuation. The interest expense will be 335 and balance 165 will be considered as my foreign currency fluctuation. So when I will make my profit and loss account, right, when I will make my profit and loss account, to I will say actual interest which I have paid is 468. To interest expense, this is as per para 4E, which is 335, and I will say to exchange loss, which is 165. This is basically breaking my foreign exchange loss into two segments. One portion which is the savings which I have tried to make, right, in interest by taking a foreign currency loan, and the next portion over and above will be treated as my foreign currency fluctuation. Then we all know that what is the treatment of borrowing cost. Generally, we know that the interest expense or these expenses will be charged to PL. But I have already told you that this standard will give us another treatment, that in certain circumstances we can capitalize the borrowing cost with the cost of certain assets. So let us look at the treatment. Borrowing cost which is directly attributable to acquisition, construction or production of a qualifying asset should be capitalized as part of the cost of the asset. Other borrowing cost should be recognized as an expense in the statement of profit and loss. So any borrowing cost which is directly attributable to the acquisition, construction or production of a qualifying asset should be capitalized or should be added to the cost of that asset. Let us understand what do we mean by a qualifying asset. Qualifying asset has been defined as an asset which necessarily takes a substantial period of time to get ready for its intended use. So we are referring to PPE, or sale, so we are referring to inventory. So qualifying asset is an asset which necessarily takes a substantial period of time to get ready for its intended use, referring to PPE, or sale, referring to inventory. And what is this substantial period of time? This substantial period is generally treated as 12 months unless a shorter or a longer period can be justified. Then it is said that these items will never be treated as qualifying asset. Inventories which are routinely manufactured on a repetitive basis of a short period of time, and the assets which are ready for use or sale. For example, let's say we are constructing a factory building and this factory building will take 3 years to be constructed and become ready for use. So since it is taking substantial period of time, interest expense which is incurred in making this building, right, will be treated as, let's say, borrowing cost which is related to a qualifying asset. This building will be treated as a qualifying asset because it is taking substantial period of time to get ready for its intended use. But if there's a ready factory building, right, it's ready for use, I buy that particular building, right, it will not be treated as a qualifying asset because at the time of its acquisition, it is ready for use. It is not going to take a substantial period of time to get ready, right? So same asset, building, if I am constructing it and it is taking a substantial period of time, it is a qualifying asset. Building which is ready for occupation, ready for use will not be treated, and if I am buying it, it will not be treated as a qualifying asset. Then what is directly attributable expense? Directly attributable expense is so direct that if you are not making the qualifying asset, that expense will also not be made. Therefore, that borrowing cost which is directly attributable to the acquisition, construction or production will be treated as borrowing cost which is eligible for capitalization. Now we will talk about recognition of borrowing cost. Borrowing costs are capitalized when these two conditions are satisfied. First, it is probable that the future economic benefits from that asset will flow to the enterprise and the cost can be measured reliably. Borrowing cost eligible for capitalization. See, when you are making a qualifying asset, right, you could either take a specific loan to construct that asset, or you could have a pool of loans which are there, and some portion out of that pool of loan could be used for the construction of qualifying asset. For example, we are making a factory building, and for the very purpose of making this factory building, we take a loan of 10 crore rupees. So this will be treated as specific borrowing. Let's say we are making a building, right, we will incur 10 crore rupees to build this particular building. We have loans to the extent of 25 crores which are taken for various purpose, and then from that pool we withdrew 10 lakh rupees, or we utilize 10 crore rupees for the construction of this building. That will be treated as general borrowing. So specific borrowings, when funds are borrowed specifically to obtain a qualifying asset, it will be treated as specific borrowing. General borrowing, funds borrowed generally and used for the purpose of construction or acquisition or production of a qualifying asset. Now, what is the amount of borrowing cost that is to be capitalized? Since this specific borrowing is directly attributable or directly related to the qualifying asset, the entire amount of interest expense which we pay on this borrowing should be capitalized with the cost of the asset. Actual borrowing cost incurred on specific borrowing less income on temporary investment. For example, we have taken a loan of 10 crore rupees to make this factory building. Initially, we have to spend 6 crore rupees. The remaining 4 crore rupees have to be paid after, let's say, 6 months. So for that interim period, we invest this 4 crore rupees and earn some interest out of it. So we need to calculate interest on entire 10 crore less the amount of income which we earn by temporarily investing this residual amount of 4 crore, right, the balance amount will be treated as the amount of borrowing cost which needs to be capitalized. But in relation to general borrowing, maybe we have 5 loans all taken at different rate, all having a different amount of borrowing. In that case, we need to calculate a capitalization rate. What is this capitalization rate? This capitalization rate is the weighted average rate of all the borrowings which the enterprise has taken other than the specific borrowing. The amount of expenditure incurred on the qualifying asset into this capitalization rate, will give us the amount to be capitalized in relation to this general borrowing. How do we calculate the capitalization rate? Total interest expense excluding interest on specific borrowing divided by total borrowing excluding the specific borrowing. So here, while we are doing the capitalization rate, always remember we will exclude the specific borrowing while doing this computation. Amount to be capitalized will be the amount of expenditure on qualifying asset into the capitalization rate. Under practical examples, under practical sums, we have covered a sum, so don't worry, we'll look at the practical solving purpose as well. Commencement of capitalization. When will you start capitalizing this borrowing cost to the cost of the asset? When all the following conditions are met, right, you will start the commencement of capitalization of your borrowing cost. First, your expenditure on the qualifying asset is being incurred. Second, the borrowing cost has been incurred, and third, the activity necessary to prepare the asset, right, for its use or sale is in progress. When all these 3 conditions are satisfied, your borrowing cost can be capitalized with the cost of your asset. So we'll take an example. Let's say we took a loan for this particular asset on 11x1. Our financial year is January to December of rupees 10 lakh at 10%. Expenditure on qualifying asset is incurred on 16x1, right, for which period borrowing cost should be capitalized. Obviously it says that all the three condition is satisfied. Expenditure on the borrowing on the qualifying asset is incurred, expenditure is incurred on this date, whereas the borrowing cost is incurred from this date. So from 1st of January till 31st of May, there was no work or expenditure incurred on qualifying asset. So the period for which the borrowing cost should be capitalized is from 1st of June X1 to 31st December X1. Prior to that, whatever borrowing cost which we are incurring will be charged off to PL. Another example, let's say construction is started from 1st of January, but we have taken loan from 1st of July. So the borrowing cost is getting incurred from 1st of July. So the period for which capitalization will take place is 17 to 31st December, because in this case, prior to 1st of July, there is no borrowing cost which is being incurred. Now we'll talk about suspension of capitalization. See, we are making a qualifying asset. We are eligible to capitalize the borrowing cost to the cost of the qualifying asset. Now, there could be a scenario where for a temporary period, the work is halted, right? Which leads to no work being done on the qualifying asset. Therefore, for that particular period, you will not capitalize the borrowing cost to the cost of the asset, but you will charge off this borrowing cost to the statement of profit and loss. The best example could be when there was a lockdown in relation to this COVID-19 scenario. All the establishments were closed and there was no work being carried out. For this period of 2 months when the lockdown was there, the borrowing cost cannot be capitalized because it was the cost of holding a partially completed asset, right? There was no work which was actually done on that asset. So capitalization of borrowing cost should be suspended, that is the expense should be charged to statement of PL during the extended period in which active development is interrupted. Another example could be we are let's say constructing a qualifying asset. There's a labor unrest, there's a strike in the factory, right? The strike continues for 4 months. So for this 4 months period also, we will not capitalize the borrowing cost. We'll have to charge this borrowing cost to the statement of profit and loss. Borrowing cost incurred during the period of interruption is considered as cost of holding partially completed asset and do not qualify as capitalization. Capitalization of borrowing cost is normally not suspended when substantial technical and administrative work is done. So actually no physical work is carried out on the qualifying asset, but maybe certain designing, drawing, layout, etc. work is done, right? So the work is being done, therefore you should not suspend capitalization. During temporary delays, which is necessary part of getting the asset ready for its use. I could give you an example. Let's say when construction of building is there, you do casting of the first floor, then you do the casting of the second floor, then you do the casting of the third floor. These casting take, let's say, 20 days to solidify, right? You need to stop the work for 20 days so that this casting could actually become concrete, and then you do the next floor. So there are temporary delays, but this temporary delay is part of the work. It has to be stopped if the asset has to be constructed. So during this interval period, the borrowing cost will continue to be capitalized. You will not suspend the capitalization of borrowing cost. Then cessation of capitalization. Cessation would mean stop. When will you stop capitalizing the borrowing cost to the cost of your asset, and you will start charging off these borrowing costs to your statement of profit and loss. First, when the asset is substantially complete. So more or less, right, largely all the work related to the asset is complete. Now the asset is almost ready to use. So further borrowing costs which you are incurring, right, that should be charged to the statement of profit and loss. The asset is completed in part. This is a very important scenario. When the asset is complete in part and the completed part can be used, right? Listen to this very carefully. When the asset is completed in part and the completed part can be used while the construction activity in relation to the other part is in progress, you should stop capitalization relating to the part which is complete. So I could give you an example. Let's say we are making a residential complex, right? Look at this very carefully. The first building in this residential complex is done. The second building is in progress. The third building is in progress, right? If we can use this first building, if this first building is ready for occupation and people can start living there, in that case, borrowing cost in relation to building number 1 should stop being capitalized and should be charged to the statement of profit and loss. But the another example could be, look at this very carefully. Let's say we are making certain plant and machinery. The plant and machinery has, let's say this is the one component of plant and machinery. This is the second component of plant and machinery. This is the third component, and this is the fourth component of the plant and machinery. Let's say this first component is ready. The work is on second, third and fourth component. Should we stop capitalization of borrowing costs on the first component? Answer is no. Why? Because on an independent basis, component 1 cannot be used. It is to be synced with all the other components and then it could be used. So on an isolation, if it cannot be used, you should continue to capitalize the borrowing cost. So let us look at it. Assets substantially complete. Capitalization of borrowing costs should cease when substantially all the activities necessary to prepare the qualifying asset is complete. Asset is completed in part when activities relating to a part of asset is substantially complete. Capitalization in relation to completed part should stop if the completed part is capable of being used while the construction on the other parts continues. So the main deciding factor is whether the completed part can be used independently or not. If it can be used independently, stop capitalizing the borrowing cost, charge it to the PL. But if the completed part cannot be used independently, then you should continue capitalizing the borrowing cost. We'll talk about disclosure. You need to disclose the accounting policy in relation to your borrowing cost, and you should state what is the amount of borrowing cost that has been capitalized. So now let us look at the practical exercise. Let's come to sum number 1. It says X Limited began construction of a new building on 1st January 2016. It obtained rupees 1 lakh special loan to finance the construction of the building on 1st Jan itself. So this is specific borrowing. Interest expense in relation to the specific borrowing should be capitalized at the rate at which the borrowings have been taken at an interest rate of 10%. The company's other outstanding 2 non-specific loan, they have taken loan of 5 lakh and 9 lakh. One is taken at 11%, another is taken at 13%. The expenditure that were made on the building project, January, April, July, December, various amounts have been incurred, right? So what has happened is in January, the specific loan was taken. So out of this 2 lakh, 1 lakh would have been spent from the specific loan and another 1 lakh would have been spent from the general or non-specific loan. Building was completed on 31st December, so it took period of 12 months. Following the principle of AS 16, borrowing costs calculate the amount of interest to be capitalized and pass journal entry for capitalizing the cost and the borrowing cost in relation to the building. So see, the total expenditure which we have incurred is January 2 lakh, 1 lakh from specific borrowing and another 1 lakh from general borrowing, and then July, April, July and December total expenditure we have incurred is 10 lakh 20,000, right? This interest will be calculated from January to December, April to December, 9 months, July to December, 6 months. For the month of December, it is 1 month. For general borrowing, we need to calculate the capitalization rate, and capitalization rate is the weighted average rate of non-specific borrowing. We should not include specific borrowing in that. So 5 lakh rupees of loan was taken at 11%, 9 lakh rupees of loan was taken at 13%, divided by 5 and 9. So this is your weighted average rate, which will be treated as a capitalization rate. So for amounts used from general borrowing, we'll multiply it with the capitalization rate, and total amount of 74,189 should be capitalized as your borrowing cost. Now journal entry, 10 lakh 20,000 plus this borrowing cost, 10 lakh 94,189, building account debit to bank account. Then we'll move on to the next question. It says Rajan company has taken a loan of USD 20,000 at the beginning of the financial year for specific project at an interest rate of 6% per annum payable annually. So this is in relation to para 4E. On the day of taking the loan, the exchange rate between the currencies were rupees 48 for a dollar. The exchange rate at the closing of the financial year was 50 for a dollar. Corresponding amount could have been borrowed by the company in Indian rupee at interest rate of 11%. Had he taken the same amount of loan in India, he would have paid interest at the rate of 11%. Since he has taken it from US, he's paying an interest of 6%. But by taking this loan from US, he has exposed himself to foreign currency fluctuation. We've already seen that the time at which he has taken the loan, the exchange rate was 48. But right now, at the end of the year, the exchange rate will become 50. So there's a loss of 2 per dollar. Determine the treatment of borrowing cost in the books of accounts. So first we'll state the related para from the standard. Borrowing cost includes exchange differences arising from foreign currency borrowing to the extent they are regarded in the exchange of interest cost. Therefore, exchange difference to the exchange of difference between interest on local currency borrowing and interest on foreign currency borrowing is to be treated as your borrowing cost. So let's look at the solution. Total loan which was taken was $20,000. The time at which the loan was taken was 48 per dollar. So 9,60,000 is the total amount of loan which we have taken in INR terms. The difference between interest on local currency and foreign currency. Had we taken this 9,60,000 of loan in India, we would have paid interest at the rate 11%. So we would have paid a total interest of 1,05,600. But actually we took this loan in USD, so on 20,000 USD we paid interest at the rate 6% and the closing rate is 50. So we actually paid an interest of 60,000. So we made a savings in interest of 45,600 by taking this USD loan. But our foreign currency fluctuation is 40,000. So this entire foreign currency fluctuation is getting consumed by way of savings in interest. In this case, the amount of exchange difference is 40,000, which is less than the difference in the interest on local currency and foreign currency of so much, and the entire amount of 40,000 should be treated as borrowing cost. Nothing should be treated as your foreign currency fluctuation. Listen to this very carefully. Had this foreign currency fluctuation be 70,000, right? I'm just giving you an example. Then in that case, we would have broken this into two parts. 45,600 would have been considered as interest and the balance amount should have been considered as foreign currency difference. But in this case, the exchange difference is less than the savings in interest. So the entire fluctuation will be treated as an interest expense. So total borrowing cost is 60,000 of actual and 40,000 as per para 4E. Total interest expense will become 1 lakh. Absolutely clear about this? Then sum number 3, it says Vittle Limited borrowed an amount of 150 crore on 1st of April 19 for construction of a boiler plant at the rate 10% per annum. So 150 crore worth of loan has been taken on 1st of April 19 where the interest rate is 10%, and this is specifically for the purpose of construction of a boiler plant. The plant is expected to be completed in 4 years, therefore it's a qualifying asset because it is taking substantial period of time to get ready for its intended use. The weighted average cost of capital is 13%. The accountant of Vittle Limited capitalized 19.50 crores for the accounting year 31st March 20, which is the year end. Due to surplus funds, out of 150 crore, an income of 1.5 crore was earned and credited to the profit and loss account. Comment on the above treatment. See, there are two things which we need to note. This is a specific loan which has been taken, and in case of specific loan, we don't use the weighted average rate or the capitalization rate. Interest on specific loan is always computed at the rate at which that loan has been taken. Here what the accountant has done is, he has on 150 crore, he has applied the weighted average rate which is 13% and he has computed 19.50. But actually this is wrong. On this 150 crore, you should apply 10% and the interest expense should be 15 crore. The second mistake which he has done is that out of this 150 crore of specific borrowing, certain funds were temporarily invested and there was an income of 1.5 crore. We do not take this to the statement of profit and loss. We've already seen that if there is any temporarily, let's say income which is generated, right, we will reduce this, right, we will reduce this from your expense. So what we have to do is 15 crore is your actual expense on the specific borrowing, and 1.5 crore is your income, so 13.5 crore is the amount to be capitalized. So let us look at it. Right, so we'll say actual interest for 1920, 10% of 150, 15 crore should be the actual interest, less income on temporary investment or specific borrowing, 1.5 crore, and 13.5 crore should be the amount capitalized. Please go through this text, because here I have mentioned that what is the treatment or what is the relevant para of the accounting standard which will be applicable in this case. So by this we are done with very important practical questions on accounting standard as well as the revision. If you like this revision video, please give a feedback by commenting and liking the video. Do share it with your friends, and please subscribe to our channel and let your friends know as well. Thank you so much and all the best.